Welcome to Forum 360. I'm your host, Leia Love, where we have a global outlook from a local view. Today, we have Ms. Lynn Clark. She is an attorney and the former executive of the Fair Housing Contract Service. So today, she will be talking to us about the lending disparities with minorities in Summit County in the Akron area. Thank you for joining us today, Lynn.
You're more than welcome.
So first, let's start with how did you become involved in this area and focusing on what you're focusing on with this?
My career has always been in housing. And when I joined the Fair Housing Contract Service in 1992, one of the issues that was really important at the time was fair lending. Whether or not banks were in fact lending in minority communities, to minority families, to neighborhoods where investment was needed. And we started looking at that, and especially really concentrated on the end of the 1990s up leading to the financial crisis, because we saw that the lending patterns really were changing in some negative ways, that the kind of loans being given, the populations being targeted for some really bad loans, or the minority populations being targeted for really bad loans. So I really started looking at it. After 2008, I was no longer at Fair Housing, but I continued to have an interest in the patterns of lending. And in the recent years, I've gotten involved with some community groups that are looking at neighborhood reinvestment. How do all of us reinvest back in the communities? So that's where my interest has come from.
Okay, so when you say neighborhood reinvestment, what does that mean and look like?
Well, when you take a small neighborhood, let's say 10-block area, and you see that maybe 60% of the housing is rental now. And when a house comes up for sale, the value is usually dropped, often, especially after 2008, often because of a foreclosure. Well, then you would happen, after 2008 especially, a lot of investors started buying up these foreclosed homes, because a house that might have been worth $70,000, $80,000, you could suddenly buy for $40,000. So a lot of people got involved in being absentee landlords. They saw an investment possibility because they could rent for a pretty decent rent, a house that was probably in pretty decent condition. And so they started doing that. Well, a lot of those investors they had cash to spend. They were not borrowing from banks. But people who wanted to borrow from banks, all of a sudden the credit tightened. So if you were 28, 29 to 30 and you wanted to buy your first home and you were working a job, all of a sudden the credit tightened up. You needed to be working for a longer period of time. You needed to have meet a higher standard. You had to have a higher down payment. And that just made things really difficult for folks. Housing became abandoned in many neighborhoods. So we started looking at both who was getting or not getting loans, but also what neighborhoods were struggling because of vacant properties. And if you look at Akron, there's a lot of vacant, abandoned homes, and there's a lot of properties that are being proposed for tear down that might be able to be salvaged if there were borrowers. We're still trying to find those borrowers who qualify, or who might qualify within a year or two to buy a house. Mm-hmm. And that's really, there's a challenge there of how to find those folks and to make sure they understand what it is they need to do. Then the flip side is, we need to keep looking at the banks and the lenders as to what are they doing? How are they setting up their loans? How are they reaching out to people? How are they getting people ready to borrow?
Okay, so you mentioned challenge. What's been, some of your biggest challenges with this area?
Well, the first thing is that financial institutions, including banks, are not reinvesting back into the cities. And I'm not just talking the inner city, I'm talking the cities. Even the outer edges of the cities where the property values are still pretty high. Banks have stopped investing. They're closing branches. Now, they will say it's because everybody's moving to online banking. Well, that's true for a lot of folks and a lot of people. But still, when you want to get a mortgage, a loan, a home improvement loan, a refinance loan, or a purchase loan, you need to go see somebody. And if you don't have a branch in your neighborhood, a place where you have a relationship, then, you know, who's paying attention to your neighborhood? Where do you go? And I have a concern that the banks, when I was growing up, when I was in school, we used to get a passbook every week. We'd put a dime or a quarter or a dollar, and we'd deposit in the bank, and we'd get a passbook. That taught us about financial, you know, matters, how to save money, what it meant to withdraw money, how to spend it. Banks don't do that anymore. You know, there's very little marketing and outreach in the neighborhoods where lending is very important.
Good. So what does the Community Reinvestment Act and Home Mortgage Data Act mean to the Akron area?
Well, in the late 1970s, now the Fair Housing Act was passed in 1968, and that's where segregation was outlawed in housing, and a lot of changes were happening. In the 1974, they started looking at financial. Up until 1974, it was legal to deny women loans. You had to have a husband if you wanted to get a loan. Well, by 1978, it was quite clear that the law wasn't enough. We needed to look at what were the banks and the lenders doing. So the Community Reinvestment Act was passed, and then shortly thereafter, HMDA, Home Mortgage Data Act. The CRA says quite clearly the banks have to show continuing investment in low and moderate income neighborhoods, in neighborhoods of color, in communities of color. And, you know, not just blacks, but Asians, Native Americans, Latinos, other populations that have been traditionally immigrant populations that have been left out of the lending, the high barriers to them being able to use the services. The HMDA Act is where the banks have to actually report information on every loan, every mortgage that they provide to somebody. For example, in 2017, there was about 18,000 mortgages issued in Summit County. Now that's a fair number of mortgages, but no bank has more than like 7% of the market. There's 300 and some lenders that have mortgages in Summit County. There's only about 20 of them, though, that actually have a physical presence in Summit County. And that, you know, so we look at those 20 that have physical presence, say, what are you doing in our community? And I'll give you an example. We have about $14 billion in deposits in Summit County. That's everybody's money. Banks, that's the government money, the parks, the library, every government entity, that's business deposits, and that's an individual, our money on deposit in the bank. $14 billion. That's a lot of money. How much of that is coming back to us in our community? Now, you know, a lot of it does. The government, you know, pays payroll and everything else. So a lot of it does come back, but how much is invested back in our community in terms of mortgages, auto loans, student loans, and some other things like that? You know, and we start looking at those numbers, it's quite clear that a lot of that investment is not coming back to our community. There's a proposal now to change the CRA, the Community Reinvestment Act, to broaden the scope. Right now, they have to report local. So I can pull up Summit County data. They're proposing to go on a more regional basis and to actually include areas that are outside of metropolitan areas, like more rural areas, where they in fact may not even have a bank branch.
Okay.
But for some reason they've done a mortgage. And they want to be able to claim different things now as a CRA activity. CRA means show us the investment in a local community. They're now proposing that other activities might be included as a community reinvestment activity. For example, there's a language that says if they're issuing loans in areas or have activities in areas where they don't have a physical branch. I'm like, does that mean if they don't have a physical bank branch, but they own a payday lender?
Right.
Does that mean the payday lender activities to low moderate income communities counts as a CRA activity, even though we know how dangerous payday loans are? So we start looking at that, and my whole focus is how much are they investing back in our community? And when I look at the mortgages, There's not a whole lot of activity. You know, maybe out of $14 billion, every year there might be about $100 million in mortgage money flowing. Now, there's a lot of mortgages out there. Some get paid off, some new. So, you know, it sort of balances itself at times.
Now, this data that you're talking about, how is it collected? And how do you go through all of the information?
Well, the deposit information is submitted to the FDIC, the Federal Depository Insurance Corporation. So they're the ones that track the deposit. The HMDA data can be gotten through several different things, including the FDIC, the OCC, the Office of Comptroller of Currency, and the Federal Consumer Protection Bureau. And what I do is I just download the data. I dump the data from the FDIC and the other websites so that I can look at it. Every mortgage is identified by census tract. So I can actually find out how much the mortgage is, what was applied for, whether the loan was approved or denied, how much was asked for and how much the loan was worth, where it's located. So I can compare the HMDA data to census data. For example, I can pick out, let's say, low to moderate income neighborhoods. Now, I define a low to moderate income neighborhood as where the average income is below 75% of the countywide average income. Countywide average income is about $62,000.
Okay, Summit County.
Summit County. So I'm looking at 45 to 50,000 in that range as being low to moderate income.
Okay.
And I'm looking at that, and I'm looking at how many mortgages have been issued, either in neighborhoods that meet that criteria, or to people who meet that criteria, or folks who live in those neighborhoods. And I can look at it in terms of race. I can look at some of it in terms of gender, although gender, they don't always report what the gender is of the person applying, or especially if there's two applicants, like a husband and wife. You know, we don't always see that data. So I'm looking at that data. I can get it down to some really fine details. You know, if you want to get in the weeds, I can get in the weeds.
Okay, and if you are just joining us, I'm your host, Leia Love, and we have Lynn Clark, who is an attorney and a former executive director of the Fair Housing Contact Service. And we were talking about disparities in minority lending in the Summit County area. So let's talk about what were some of your findings, and are the local banks discriminating according to these findings?
Now, I'm always hesitant to say anybody's discriminating. Because there's two kinds of discrimination. One is the direct discrimination, where someone is just turned away at the door, or given a hard time, or just, and I've heard of these complaints. I know of these complaints where somebody's like, oh, you know, it's really nice that you came to us. We don't have enough money to lend you today. They're not saying it's because of your race or your gender or your national origin. They're just being very nice and saying, we don't have the product you need. That's direct discrimination. Someone's sitting there and they've been turned away. Disparate impact is what we're looking at. And is there policies or procedures, something that is in fact impacting a protected group without deliberately turning them away, but in such a way that means they're not going to be able to get a loan. For example, many lenders have policies that say they will not lend if your house is worth, or the property you want to buy or refinance, whatever, is worth less than $70,000. Now, yeah, where are those houses located? For the most part, a lot of those houses are in Akron. And a lot of those houses may be in what's considered to be low to moderate income neighborhoods, which means they're not telling people you can't get a loan. It's just they're not doing any outreach to you to make sure you can get a loan. They're not working in those neighborhoods to raise their level of services in those neighborhoods. That's a disparate impact. That means they're ignoring certain things. Yes, it's quite clear that throughout the county and the city especially, that low to moderate income neighborhoods are being underserved. They're not as much marketing in there. And yes, I can show those numbers. Can I say that any specific bank is discriminating?
Right.
No, I can't. And I'm very hesitant to say that because, you know, I mean, everybody's, let me put it this way, every bank's doing the same thing. Every bank is out there. Every bank is not pushing these loans, or I won't say pushing these loans, but giving these loans in the neighborhoods as they should be. There's no one bank that's worse than the others. Although I do have, for example, part of what came up in the last couple of years is when Huntington Bank bought out First Merit. That opened the door to really looking at what was First Merit doing, what was Huntington doing. Now, First Merit was the largest bank. They had the largest footprint in Summit County. It was a hometown bank. They had a very poor record of doing home mortgages. And not just in low to moderate income communities or to people of color. They didn't do a lot of mortgages. Huntington is doing more. And they're actually now, Huntington with First Merit, the base, is actually like second or third in lending in Summit County. But yet when you look, they still only have about 5% of the mortgage market. And when you look at the statistics, which I brought here today, 85% of the Huntington Bank's mortgages go to whites.
85%.
85%. Now, for county-wide, that's not too bad because in the county, it's about 16 to 18% of the population is minority. So they're pretty close on that. In the city, but only 9% of their mortgages go to African Americans, blacks.
9%.
So, you know, they're really low in that area. When you look at Akron, Akron gets only 34% of Huntington's mortgages overall. Now, city of Akron's about 198,000 people. About 96,000 households, if I'm not mistaken. Summit County is about 230,000 population. They've got roughly maybe 115,000. They're somewhat balanced between Akron and Summit County. I mean, yet Summit County by itself, outside of Akron, gets 61% of the mortgages. Now, there tells me that the city. Now, some people say, well, that's because there's more building in Summit County. There's more new construction stuff. And it's a higher income. So, you know, maybe there should be more activity, but that's a huge gap. That's a really big gap. Akron gets 24% of all the mortgages. Summit County gets 61%. That's a huge gap. Yeah. And when you're looking at race, it becomes even worse. But even in, let's say, I'm going to look at the, I'm going to turn here to look just at the city. And when I look at, okay, I've got Akron only. You know, when we look at total apps, in Akron, for Huntington Bank, there was 211 applications submitted. 58% of them came from whites. 27% came from blacks. Well, I'm sorry. This is low to moderate income neighborhoods. I got to get my thing here, you know, as to how these are working. The gap between the whites and the blacks, even in the city, continues. And when you look at the approval rates, whites are higher than blacks. Whether you're looking at low to moderate income neighborhoods, whether you're looking at minority neighborhoods, or whether you're looking at high income neighborhoods, white approval rates is higher than blacks.
What's the criteria for lending?
Well, you obviously have
factors
to.
That go into
you
that.
obviously have to have a good credit. Got to have a good credit history. You can't have a bankruptcy, for example. You can't owe more than, usually what they look at, they want to see that your housing expenses are between 35% and 40% of your total income. You know, so if you're making $60,000 a year, they want to make sure that about $24,000 is the maximum you're spending on housing. When I say housing, it's all housing. It's utilities included. So it's not just a monthly payment on a mortgage. It's property taxes. It's your utilities and everything else. So they want to make sure, one, you have enough income. Two, they want to make sure you have that history of paying your bills. Whether it's, and a lot of people don't understand, it's not that you can't have too much debt. You've got to be able to pay that debt. So if you're making $60,000 a year, but you're carrying $10,000 in debt on your credit cards, well, that's pretty burdensome. And if you're only making the minimum monthly payments, that says, are you prepared for an emergency or something that happens? You know, it says all these factors that go into it. Have you paid your bills on time in the past? Whether it be your gas, electric, phone bill, cable bill, or your store credit card. Have you paid on time? Also, are you 3 days late sometimes, 5 days late? Have you had a car repossessed? That's critical too. You know, have you had things taken back from you? Have you had credit denied to you for other reasons? They don't look at criminal records, although some people think they do. They don't look at criminal records. They look at, do you have a steady income? Is it a stable income, reliable income? Is your debt manageable? Those are the things. There are agencies in town that will help people figure that budget out.
Okay.
And then the other critical thing is, do you have a down payment? The banks want to know, do you have an investment in your own housing?
Okay. So if somebody feels as though they have been, they qualify, but they were turned down for it, what would be some of the things that they could do to go around, resources?
Well, the first thing is to realize that you may not have been turned down. You may simply have not had an application accepted.
Okay.
This is one of the things with some of the numbers. There's a fair number of people who submit an application and then they're neither approved nor denied.
Okay.
The file just gets closed for whatever reasons. Makes you wonder why it's getting closed, but it gets closed. I've heard reports of people going to banks who, again, are just told, we don't provide that kind of mortgage. We don't provide that kind of loan. We don't do FHA mortgages, which is another issue. So you may not have been turned down. You may have simply been turned away.
Okay.
Now, if you've been turned down, obviously the first thing you do is ask why. And get oh, well, you just didn't qualify. No, why did I get turned down? Was it my credit score? Was it my lack of a deposit? Was it this, that, or other things? And they should be able to give you specific details.
Okay.
If you think it's unjust, then you go someplace like the Fair Housing Contact Service and you say, I think I was turned down unfairly. And they can help you file a complaint with the state or the Department of Housing and Urban Development to investigate it, to see if it's a pattern that, or you got turned down because, and I've heard of people who've been turned down and they're like, oh, we just, and then they file successful complaints because the person who makes the decision, the underwriter, can't come up with a really good reason. Well, I didn't think you had enough, I didn't think your income was high enough or stable enough. Like, well, I've been working here for 3 years, this. Mm-hmm. Well, you know, the market's unstable. I'm still working. You know, so you can go into that with complaint. If you think you've been turned away, you can also go to the Fair Housing Contact Service. Mm-hmm. And that's where we start to look at these numbers. Does the bank have now, one of the things about a mortgage, what we call a mortgage originator, those folks in the bank that write up the mortgages, that they get paid by commission. Mm-hmm. The amount of money it costs to process a mortgage, it doesn't matter what numbers are on the page. It's cost the same amount of money to process a mortgage, whether it's a $70,000 mortgage or a $500,000 mortgage. It's about the same amount of time, about the same kind of paperwork. It costs maybe $2,500 to $3,000. But the person who approves that mortgage and who processes that paperwork gets paid a commission based on how much the mortgage is. So the higher the mortgage, the more profit the bank makes, the bigger the commission is. So if I come to you with $10,000, $50,000 mortgages, mm-hmm. I come to you with $1 million mortgage, which one are you going to process? You're going to process the big expensive one because you get a bigger commission. You know, so you know that's how it works. Yeah. That I don't want to, and banks pay those commissions so they can give people an incentive to push mortgages out. You know, and that's part of the whole philosophy of what I'm trying to look at and have the banks look at. What are they doing? If you only need to borrow $7,000, where can you go to get $7,000 to fix that roof? Mm-hmm. Is the bank willing to give you a 5-year mortgage on that $7,000? Or do they want a 2-year mortgage so it's a quicker turnaround? Can you afford 2-year? Or do you need 5 years or even 7 years to pay it back?
Okay, so how can we contact the Akron Reinvestment Coalition or anybody for more information?
Okay. My suggestion would be if you're looking for home mortgage information, The housing counseling agencies are Mustard Seed Development Corporation, the Fair Housing Contact Service, and United Way now has an empowerment center. They're all helping folks, first-time home buyers or people with credit issues, that are interested in housing. If you have other housing issues, there's a lot of nonprofits throughout the entire community, the Community Action Council, Legal Aid, Summit County, the Health Department, a lot of people in the coalition working on housing issues, because we want to create healthy neighborhoods for everybody, and that just doesn't mean like health issues, but that means neighborhood relationships and everything else.
We are unfortunately out of time for today, but I want to thank you so much for your information. Real quick, in like one line, if you could leave people with one little piece of advice about this area, what would it be?
Look at your neighborhood. What's happening in your neighborhood? Because the value of your house is dependent upon what your neighborhood looks like and what's happening in your neighborhood. If no one's making an investment in your neighborhood, if they can't get a mortgage, well, how are you going to be able to sell your house? How are you going to be able to do improvements?
Thank you. I'm your host, Leia Love. Thank you again for joining us today on Forum 360, where we have a global outlook from a local view. Have a great week.
Forum 360 is brought to you by Electrical Impulse Communications, the John S. and James L. Knight Foundation, Hudson Community Television, the Rubber City Radio Group, an anonymous donor, the Jewish Community Board of Akron, Medical Mutual of Ohio, Blue Green, and Forum 360 supporters.